Welcome to TheoTrade. This is Don Kaufman, March 20th, 2020. You are watching the TheoTrade Weekend Update. Is this the beginning or the end? It was a long week if you traded. I mean, you traded, you watched news. It was exhausting. And we're getting to the point right now where you kind of feel that way if you are involved in this marketplace. I mean, it's exhausting enough, again, listening to the news on a day-to-day basis. Watching these markets, though, we are now effectively into the fourth week, again, the fourth week of what can only be described as the most extreme volatility ever recorded in this business. And I'm actually going to break that down here momentarily with some statistical significance, but what you're looking at to begin with here is the SPX, right? So it's the SPX, which is the S&P 500 index options. And I wanted to show you when I said the fourth week of significance, obviously this is 1 week, there's 2 weeks, 3, and now of course we're into the fourth week. As I said a moment ago, the SPX this week took a hit of 406 points. Now, to me, points don't mean that much unless, of course, you relate it to what's termed expected move, which we're going to look at here momentarily. But net, I think it's critically important to discern kind of where we are on the year. And right now, what that amounts to is none other than about a 29% move down year to date, specifically on the SPX. After we kind of crested, we were up just about 4%. We're now down about 29%. So if you looked from absolute high to low, you know, you're facing here almost a 35% move down inside of the SPX. How are some of the other major index products faring? And, you know, I like to also pull up the Nasdaq. In this case, I'm actually looking at the Qs. I'm going to make a comment about the Nasdaq as we go a bit deeper into this video, because I still think that there's quite a bit of opportunity in there, you know, to kind of answer that initial question, is this the beginning or the end? Okay, there are certain sectors that we're going to start to rotate capital into. Okay, however, the Nasdaq, from where I stand, and strictly my opinion, there is huge room for potential and downside momentum, okay, still very much possible inside of the Nasdaq. I think obviously that's not it's not a great comment to make, right? I think that the good portion of that, the marketplace is going to favor you if you are bearish, and I'll describe precisely what that means here momentarily. So looking at the Qs, they were up at one point about 10% in the year. They're now down about 21%. One of the things, though, that we're just not seeing, okay, in this sell side activity, the marketplace is kind of fractured, broken apart. We're not seeing incredibly high percentage correlation from the S&Ps to the Nasdaq. Okay, and last but not least, I'm going to pull up the IWM, which is the Russell. Okay, the Russell it's just getting decimated. So the Russell at one point was up roughly 2%. It is now down a staggering 38% on a year-to-date basis. Well, I mean, we're talking, again, statistical significant levels that can only be compared to a handful of times ever in market history. Unfortunately, we don't believe some of the sell-side activity is over at this point. However, that being said, okay, the IWM, the Russell, this is actually a place where you may see some capital starting to flow towards. And today is a perfect example of just that. If you take a look at the Russell, and I've actually highlighted in this particular case, I'm actually going to pull up the Russell futures right there. The Russell futures are only off, okay, just about 2.25%, with the S&Ps down about 4%. So although capital hasn't come rotating necessarily into it, it's starting to make a little bit more sense on a larger level, which again, I'll explain here momentarily. So before I go any further, I want to bring you back to the SPX, because this is important, okay? The SPX in this past week of trade had a $226 expectation of price movement. Actual movement, 406 points. Now, I know that everybody's talking about volatility and oh, volatility is this and volatility is so high. I mean, come on, get out there and sell something. I'll reiterate once again. I am only nibbling by selling premium. By the way, the markets, they're still open here. We're only half an hour after the close. They reopen the futures. They're continuing to sell off after. Okay, after. They are still selling this marketplace into the oblivion. All right. So, again, there's this commentary, we got to sell premium. It's the best volatility we've seen. Okay. What you might be missing at this point, okay, is that we're still outside of the expected moves. So to explain again expected move, and I want to clarify for those of you that are a little bit newer to this and bring into full scope here, okay? Expected move has everything to do with the options market. That's what it's based on. It's based on the options market. And the SPX, it's an options only product. What options do is they handicap risk to the future. So you can say, hey, what is this marketplace going to look like 7 days out? Okay, now 7 days out. So that's March 27th, right? March 27th, it's next Friday. Well, we're only supposed to move 228 points. According to this, we're only supposed to move 228 points. Now, it doesn't say that we can't trade outside that level, okay? But by the end of the week, we're supposed to be inside, okay? That's one standard deviation. Did we do it this past week? No, I just told you a moment ago. We moved, 406 points. Okay, so in that, the quest to sell options premium, it's starting to emerge, okay? And you've seen what you believe is shock and awe. But quite frankly, the market sees it very different. The actual movement of market is still exceeding implied movement, not just by a little bit. How do I say this eloquently? By a freaking monstrosity. Do you not see it on my screen? In fact, again, I'm going to highlight this because, this is the point of me, highlighting these. Okay? These are breaches. These are breaches of expected move. By the way, this was like a 6 sigma move out here. Okay? All of those are breaches. So in each one of these weeks, and I want you to see there's 1, there's 2, there's 3, there's 4, there's 5, there's 6, there's 7, okay, 8, 9, 10 weeks. In 10 weeks, we only had 1 out of the last 10 weeks that's inside expected move. Well, let me actually calculate it and give you this terms, okay? 9 out of the last 10 weeks have seen moves outside the expected. What does that really mean? It's pure, utter chaos. That's what it means, is the marketplace was ripped apart at the seams. Statistically speaking, okay, that can't happen. If you're looking at a distribution curve, okay, if you're looking at a distribution curve and you say that 68% of occurrences are supposed to happen in here, okay, and you're now, 10 weeks through it, and only 1 out of the last 10 weeks can even come inside one deviation, then this deviation, it's all wrong. We're trading out here in the fat tail land, okay? That's where we're at. Fat tails. You got to recognize, though, okay, it's a sign of the times right now. If you think that volatility is going to start to calm down to any degree, right, I suggest that you wait, okay, and see for a week or two us close inside an expected move before you start feeling all warm and fuzzy about yourself. Because people, it's not just wild out there. It is downright serious. And again, I want to show you something that I think is of critical importance in understanding. And it's one of the reasons we track these expected moves. And again, the next week is expecting like a $228 move. Okay. But one of the reasons we track this expected move, what can be discerned from it? We had 23 consecutive weeks inside of expected move, 23 consecutive weeks, a period of incredible efficiency. Now, okay, we've had 9 out of the last 10 weeks. But here is something that I think a lot of people missed, and you can go back in some of the videos and watch this, okay? The marketplace was breaking apart before we saw the sell side activity, and I cannot stress, okay, that logic enough. The marketplace was breaking apart. There's a breach to the upside. There's a breach to the downside. There's a breach to the downside. There's a breach to the upside. Another breach to the upside. A breach to the downside. That's before the volatility kicked off, and people ask why I was going nuts, okay, firing off positions back here. Because the marketplace was coming apart at the seams already. Now, okay, we're off the rails, people. We're completely off the rails. And they're still, though, okay, I believe, kind of constrained with the volatility estimates that they're giving. And when I say volatility estimates, I'm talking about the expected move. You know, I have trouble wanting to sell premium. I'm starting to dabble a little bit. Again, I'm starting to dabble in selling some premium. But when the expected move is 228 and I just saw a 406-point move, hey, excuse me, I'm a little bit nervous. Okay, I ain't stepping in there with my capital and starting to sell stuff. Okay, we're at points now where trading firms are going to get blown apart because we're hitting the edge of the expected move and crossing right through it without any regard whatsoever. All right, continuing on past the expected move. We have downright confusion in day-to-day internals. Okay, let me actually show you what that amounts to. Okay, we've had days this week where we saw the S&Ps selling off. Okay, and by the way, we're right now literally 10 points away from the lowest lows that we have seen, which came on this Wednesday. But when I say there's confusion in the day-to-day internals, it's making the tape next to impossible to read for an intraday feel. Like those of us that sit here all day intraday and you're like, yeah, you know, I think the S&Ps, you don't think anything right now. You can't, because there was no sign the S&Ps are going to sell off. And I'll show you exactly what I mean by this. First of all, I'll start with the bonds. We had days this week where the bonds were selling off with the market selling off. Okay. I mean, that's just complete and utter turmoil. Literally, the bonds were selling off heavily, hard, with the S&Ps selling off. Now the bonds are back to rallying with the S&Ps being down. At least that's normal. Then it gets better. If you take a look at volatility, okay, this is actually the VIX. The VIX contracted significantly today with the S&Ps down almost 5%. This one, though, I actually have a reason for this. How could volatility be down with the market down big? Because a firm blew up in Chicago. Proprietary trading firm. You know what the proprietary trading firm does? Okay. They were trading heavily inside of the VIX. The trade got away from them and they liquidated the positions, okay, mainly yesterday. So the VIX was actually up a bit yesterday and it contracted quite substantially today. So there is a specific reason for that. It was a liquidation, okay, of a firm that actually caused a lot of these odd readings on here. So again, confusion in the day-to-day internals. All right, but I want you to see something also that I think is a little bit chaotic in here. And I'm going to come all the way to the bottom of the screen for this one. Okay, and we're going to go down to the VVIX. This is the volatility, once again, to the volatility index. The VVIX, a high VVIX is over 110. Is over 110. We're like right now, 187. And on the bid. So I point this out to you because I started with the question, is this the beginning or the end? What do you think? And once again, trading firms are quietly buying volatility in the backdrop of a marketplace that's already down 30%. Right now, down another 5% here in the after hours. Marketplace is down 30% on a year-to-date basis, and they're buying volatility inside of the VIX. So for right now, don't worry about the VIX. The VIX, okay, is pricing a little bit funky because the expiration and because a firm was actually blown out of their position. Same with the volatility futures. They contracted because this firm was blown out of their positions. Okay. What is, again, very, very confusing in here, though, and when you start looking at correlations, all right, the marketplace ended the day, okay, 10 up, 90 down. But throughout the course of the day, we actually had 50-50 advanced decline lines. We're starting to see a couple of capital rotations. And I was going to bring this up a little bit later, but if you take a look at stuff like the emerging markets actually finished slightly higher today. The energy sector, which has had, it's just been beaten into a pulp. Okay, look at the energy sector on a year-to-date basis. That's down 57%. Okay. They're rotating into it a little bit. So from a market internals perspective, like we look at, a lot of different things. The only problem is there's things that simply don't make sense. I'll give you another one here. Gold. Okay. Gold today actually caught just a little bit of a bid, but we also saw points in time throughout the course of this week where obviously gold has been selling off. Now, why is gold sell off when the rest of the market's selling off? Because they're liquidating gold to ultimately cover, okay, their margin behind in other areas. Today, though, they're back buying it, okay, they're back buying gold. And then again, oil down and down in another big way, almost 10%. The confusion, when I say confusion in day-to-day, internals, think about this for a second. Energy sector ended the day higher. I just pointed that out a second ago. Energy sector ended the day higher with oil down some 10%. Got some catch-22s. Again, all of this stuff right now, like if you look at it and I'm like, it's confusion, don't take that as a negative, people. This is where everybody's running scared, okay? And opportunities start to really open up. The correlations are all over the place. The volatility is all over the place, okay? The emerging markets, the energy sector, they don't even make sense right now, okay? And again, all of this is to your benefit. Now, big points, okay? And I want to really kind of drill this into you. Something I've been talking about day in and day out. You've heard me talk about taking positions in Walmart, okay? Listen, I talked about this expressly on the Wednesday night video. Walmart, get short. Well, it's working a little bit today. The consumer staples, they're hammering consumer staples. In fact, to look at XLP, take a look at XLP today, actually broke to new lows. So the rest of the marketplace is facing new lows, but the consumer staples, which is, I was told it was going to hold up, people are going to buy toilet paper, they actually broke them. They broke the back in consumer staples today. I would expect Walmart from this point forward, okay? It may have some pops, but it's going to be a lot about drops. Think about this. On a year-to-date basis, Walmart's only down about 4%, with the S&P's down almost 30%. So you better believe that they're going to be coming, because when they do come for this marketplace, they got to come for them all. And that's one of the things, when you ask this, is this the beginning or is this the end? Consumer staples, they're already hitting. So I suggest, again, that pay very close attention here. The Walmart short is over. If it continues, it continues. If you're in it, great. This is not a time to step in and try to short Walmart. This is not, by the way, I am continuing to carry multiple short positions inside of Walmart. Okay, the same is true of me inside of Costco. Okay, Costco has been a proxy for Walmart. Costco got absolutely hammered in today's trading session by the tune, again, of almost 5%. Positions throughout this particular underlying, both in-out spreads, duration positions, all hitting large degrees of profitability in there. All right, let's push aside, okay, consumer staples, because I talked about selling consumer staples in Wednesday night's video, okay? Then here's where I believe we're headed next, tech. Now, I've also been very, very critical of tech because, again, I still have this larger feeling. And by the way, I had a spread on Amazon. I put it on today, closed the spread for like a 30% profit. We're out of the Amazon spread. But I've been talking about this ad nauseum. Okay, I have looked at Apple in almost every single recent weekend video. And I said it when Apple was at 275, and I'll say it again when Apple's at 229. They still haven't hit tech hard enough. Okay, Apple's down 23% with the S&P 500, okay, down 29%. What's wrong with Apple? Okay, this is not me picking on Apple. I could care less. Buy your iPhones to your heart's content. The problem with Apple, okay, it's in everybody's mutual funds. And at this point, people are going to puke those funds left and right. And when they do, Apple is going to be caught in the crossfire. It's called redemptions, people. There's redemptions going on right now. Okay, there's a liquidity crisis. You got to understand, they're coming for tech, and they're coming in a big way. All right. Right now, I'm also looking specifically at Microsoft. Now, we're starting to make a little bit of headway again in Apple, but Microsoft only down 14.5%. I'll reiterate, I've got a position inside of Microsoft already. On any bounce inside of big tech, sell it. And that's exactly what we're going to be looking for in this next week. So we're looking for, the beginning, the end. All right, listen, we're going to probably rotate back to things like energy because energy has just been annihilated, right? We're going to rotate into things that have just been absolutely decimated. When I say rotate, I don't necessarily mean that energy per se is going to be bid. I don't necessarily mean that energy is going to have a wicked bounce. I don't want you to take me, wrong. I think that they have seen the brunt of the sell side activity, Meanwhile, although it's taken the brunt of the sell side activity, your key components to most of the mutual funds have not. And that's why, again, they're going to be the center of my attention in the days to come. The last part of this, which I want you to take as very positive over here, because all we're doing is being bombarded by negative news pretty much every single second of the day. I'm socially distant. Yeah, I'm socially distant with 3 children locked up at home. Week 2 of 3 children locked up at home. That's not social distancing. It's pure insanity. The positive side of this, spread pricing right now actually favors the bears. And I'm going to show you this, specifically inside of something like Microsoft. If you take a look at Microsoft, and I'm just going to open up options that are, you can open up 28-day options. You can open up 20-day options. Now, again, I don't want you to take this as hop into Microsoft, but look, this has everything to do with how the option skew is pricing. And when I say the option skew, if you take a look and you were to do a spread in here, like if I were to buy the 135s, and sell the 140s, in this particular case, the skew against me is horrific. And I just want to show you what it looks like, in context. Forget about, implied volatility. In context, here's a $5 wide spread. It's a $5 wide spread. When I say a $5 wide spread, look, it's a $5 wide spread for a $3 debit. Now, this $5 wide spread, buying the 135, selling the 140s, is exactly $2.35 in the money. Okay, so what? Okay, so it's $2.35 in the money, and they charge me $3 for it. Now, I want you to compare that spread to the equivalent put spread. What's equivalent put spread? All right, this would be buying vertical put spread. Buying the vertical put spread. Here it is. Take a look. The 140, 135. Now I'm going to highlight this one for you because when I said it, I meant it. Spread pricing right now favors the bears because it favors buying a put spread. Look, the put spread only costs $2.13, but do you realize that the 140 puts are already in the money by what? Almost $3. $3. Well, $2.65. But I wanted you to see that because the call spread, is still trading for what? Phenomenal amount more than the put spread. And again, they're pretty much almost equidistant to where the stock price is trading. But I wanted you to see that for yourself because you sit here and you're like, oh man, I can't do anything. Now, it's hard to get bearish when the marketplace is down 5%. But if we open flat to kind of down, listen, I executed this Microsoft trade, right? Yesterday. Was Microsoft all kinds of bullish yesterday? I executed the Microsoft trade when Microsoft was up, just a couple of bucks. It had a wicked sell-off thereafter. That's all you need, for profitability on a trade like this. Again, keep your head up. There is still a whole lot of risk to unfold in this marketplace. Do not go out, and start firing off a bunch of selling of premium because we haven't seen the marketplace normalize yet. Do not go out on wild bottom fishing expeditions yet. What I'm talking about there is, hey, just because, Apple is down some 6% today doesn't mean it's done. Remember that Apple, is the marquee stock in almost every retail trader's mutual funds, 401ks, and portfolios. And on a percentage basis, it's not down as much as the S&Ps. That is worrisome at this point in time. So don't go on your bottom fishing expeditions. Constrain yourself if you're going to sell premium, Define your risk. Keep your head down, all right? And you're going to get through this just fine. Thanks, everybody, for joining us here on the Weekend Update. I'm Don Kaufman. Be back on TheoTrade all throughout the course of this next week. Have a wonderful weekend. Bye-bye.